I'm a chartered financial analyst and investment professional, and I would never let anyone I care about invest in FEPI. Here's why. In a single sentence, FEPI, aka the REX, FANG, and Innovation Equity Premium Income ETF, offers an incredibly unattractive risk reward profile that will likely one day end in tears for its investors. Allow me to explain. It's no secret why investors are attracted to it. Right now, it's showing a 25% yield. And at the bottom, you can see it says it gives you big tech exposure, income generation, a whole lot of it, and a potential downside buffer. Well, who wouldn't want to capture all the upside tech has been having with protection on the downside and a 25% yield, right? There's just one problem. When you dive into how it works in real life, it's not nearly as good as it sounds. It's sort of like saying, I just won the Super Bowl MVP. Really? No way. That's amazing. But wait a second. Since when do you play in the NFL? Oh, I mean, I won it on Madden, the video game. Ah, so not nearly as good as advertised? Got it. FEPI's a lot like that. FEPI is a covered call ETF that tracks the selective FANG Innovation Index and writes covered calls on it. If you don't know what some of those terms mean, don't worry, I'll explain how each part works in greater detail along the way. Let's start on the bottom left, big tech exposure. The index it tracks is basically 15 of the largest, most widely traded US tech companies. They run it based on a formula, update it monthly, and the holdings are equally weighted. So it does provide big tech exposure as advertised, right? Yes, but probably not the way you were hoping. That's because of what it does to generate income. It sells call options on its holdings. A call option is the right to buy a stock, ETF, index, or other financial instrument at a set price. The buyer of the option pays what's called a premium to buy the option, basically the purchase price. And then, if the stock goes above that set price, which is called the strike price, they can still buy it at that price. So, say a stock is at $10 per share today, and they buy an option to buy it for $11 a share anytime in the next year. Then, if it goes up to $12 or $15 or $1,000 per share, they can still buy it for $11. If it goes down, they just don't have to buy it. All they're out is the price they paid for the option. Covered call ETFs like FEPI essentially do the opposite. They sell call options. So in the same scenario, sure, they own the stock, or in this case, these 15 tech stocks, but if they go up a lot, FEPI investors barely benefit. When you sell a call option on a stock, you forego the opportunity to benefit from any upside beyond that set strike price. And you can see from their prospectus that they sell call options that are only slightly out of the money, meaning a slightly higher price than the current price at the point when they sell the option. That means you can get a little bit of upside potential from the tech stocks, but you've sold most of it to someone else. FEPI hasn't even been around for a year, but let's see how this has worked in practice so far. It's up 24% in about 9 months. That's pretty awesome, right? Well, in a vacuum, yes. But not when you consider that the iShares Tech Sector ETF is up 37%. It's already trailed the tech sector by 13% in only about 9 months. So the upside potential is definitely not the same as if you just invested in tech or in these 15 companies. And that brings us to the second part, income generation. Can you really rely on getting 25% per year from this? The short answer is no, of course not. This may be the most important part of the video, so listen closely. I don't mean to be harsh by calling this person out. I'm sure he means well, but this kind of stuff really gets under my skin because if someone were to listen to this, which it seems like a lot of people have, it could be extremely detrimental to their future. If anyone tells you that you can take a sustainable 25% income stream out of any investment for the duration of your retirement and live off of that, they have absolutely no idea what they're talking about. That's why that will never work. Remember how FEPI was up 24% since inception? And remember when I said it didn't capture very much of tech's upside? Well, look at what its actual price did. It barely moved. That means that basically all of the return came from the option income. And if all the return comes from the option income, then you pretty much have to reinvest the income to compound your investment. If you don't, there's almost no chance this will go up over time. Remember, this tiny 5-ish% gain was at a time when tech stocks rallied 37%. What do you think will happen if they're flat or down or even just up less? You have to reinvest the dividends to avoid your investment just dwindling away over time. Let me show you what this looks like in a similar ETF, QYLD, which uses a similar strategy, writing covered calls on the tech-heavy NASDAQ. Since its inception over 10 years ago, it's down almost 30%. Now, this doesn't mean it's lost money. I'm only showing you price return. But if you'd been taking the income out the whole time, your income would be about 30% lower than it was before, assuming it's the same percentage yield as it was 10 years ago. I'm not sure if you've noticed, but prices of things generally go up over time. So a strategy where your retirement income goes down over time is not a good one. By the way, this is at a time when the index it buys, the NASDAQ, has been up over 465%, and still the price of QYLD has gone down. That is why you cannot rely on FEPI for income, at least not if you're going to take all of it. If you wanted to take 4 or 5% of it and reinvest the rest, we could talk. But if that's what you're doing, you have to think of it as something with a 4 or 5% yield, not a 25% yield. That figure is just totally misleading. I mean, it's technically accurate based on the current price and the last 1 month of income. But if you think you can actually take out 25% per year from your FEPI holding as income and maintain its value over a long period of time, you are sorely mistaken. So again, just like the exposure to big tech, the income is also not quite as good as it might appear at first glance. That brings us to the third area, the potential downside buffer. Now, as a career investment professional, I've seen enough and actually written enough marketing material to pick out these keywords. But in case you haven't, don't let your eyes gloss over the word potential. Potential is the key word here. If you ask me, it is likely to provide a downside buffer. That's all relative. It's likely to provide a downside buffer against just owning these 15 tech stocks, which would likely be incredibly volatile. So the buffer just means that instead of huge downside potential, you have only very big downside potential. It does not mean that this is a good strategy for downside protection or low risk. To tell you why, let's start by going back to the basics of how covered calls work. You own the underlying investment and you sell a call option on it. If the price of the investment goes up, the person with the option will capture all the upside beyond the strike price, which is the price that you agreed to sell it to them for. So you give up most of the upside potential. Still with me? However, if the price goes down, they're not going to buy it from you, so you still own the investment and you get all the downside potential. You give up most of the upside and you keep most of the downside. Not a great deal. The only downside buffer comes from the option income you received for selling that option. Sure, these stocks are volatile, so that income buffer is going to be pretty high on this strategy, 25% right now, but there are 3 important caveats to that. First, that's based on the last 1 month of income multiplied by 12 divided by the current price. If the price goes down over time, the income will also likely go down over time. 25% of $800 is less than 25% of $1,000. Second, if you're taking out the income, you're also taking out the downside buffer. If you do that, it will be very hard, actually pretty much impossible, to ever recover your value when it goes down. And make no mistake, it will eventually go down. No stock in the history of the world has ever just gone straight up forever. Don't expect these ones to do it either. You only need to look back to 2022 to see what can happen to them. More on that in a minute. The third caveat to the downside buffer is that it's only a buffer relative to the volatility on those 15 stocks, which is extremely high. These are also 15 very similar stocks. If something goes wrong in tech land, they're probably all screwed, and FEPI would go right down with them. If there's a tech downturn, FEPI will do better than these 15 stocks, but it could easily still do worse than, say, the S&P 500. I would think of the downside protection of FEPI like I'd think of the sun protection of SPF 4 in the Arizona summer. Yeah, it'll give you a little more protection than wearing no sunscreen at all, but you'll still probably get fried. FEPI's downside buffer is relative to something with tremendous downside potential, but it's really not quite what you typically think of when you read the words downside buffer. This is not a strategy to own if you're worried about downside risk, in my opinion. Let's take a look at how this works in practice. Of course, FEPI hasn't been tested in a real downturn, but here you can see it's down over 7% just over the past 2 weeks. That's about even with the Nasdaq in green and down about twice as much as the S&P 500 in red. Case in point, that's not exactly what I would call downside protection. For an example of a similar strategy that's been around in the last real tech downturn, let's go back to QYLD and its counterpart without covered calls, QQQ. Now, obviously these ETFs are not the same, I'm not saying that, and the past is never a perfect predictor of the future, but I'm showing you this as an illustration of the rough general return pattern that I would expect from any ultra-high income covered call ETF based on a risky underlying asset. That's QYLD, VEPQ, FEPI, and so on. You can see that from the beginning of 2022, as tech stocks fell, it did less bad than QQQ, but it was still down a lot. 24% in less than a year is pretty bad. And that's with the dividends reinvested. Then, as the market recovered, it also recovered, but not as much, and it fell back behind QQQ again. That's the basic return pattern I'd expect from FEPI. Less upside potential than the selective FANG Innovation Index, pretty much all of which is driven by the income, and less downside potential, but still a lot of it. If you decide not to reinvest the income, then I'd expect something more like this. In QYLD, you would have gone right down with the market and then basically sat out the recovery. So let's recap why I do not think this is an attractive investment. It's pitched as big tech exposure, income generation, and a downside buffer. But most of the return and all of the downside buffer are coming from the income. So if you take the income out instead of reinvesting it, you lose most of your upside potential, you lose the downside buffer, and you're setting yourself up for your income to go down significantly in the long run. As soon as there's any kind of meaningful downturn in tech stocks, you're likely to lose money and watch your future income potential diminish because the value of your investment will never recover. This ETF would provide attractive returns if you reinvested the dividends and these tech stocks stayed flat or went slightly up. It's totally reasonable as a portion of your portfolio for someone who believes in tech and wants some upside but with less downside risk if they're willing to reinvest the dividends. But if the 25% yield is what attracted you to it, which it probably is for pretty much everyone, then I think this falls squarely in the camp of, ooh, good to be true. While I can't give advice on this channel, I want to be clear. If any one of my friends or family members asked me if they should buy this, I would strongly encourage them not to. The only scenario where I would find this attractive is if I expected those stocks to be relatively flat going forward. The income would be high, you wouldn't miss out on much upside, and you wouldn't experience much downside. But it's a bit of a paradox because the only reason the income is so high is that the underlying holdings are so volatile, meaning they're really unlikely to be flat going forward. Thus, if I was positive on these tech stocks, I'd just buy them and capture the full upside potential. If I was negative on them, I wouldn't own them at all. If I wanted a high income, I'd look for something where it was more sustainable in the long run. Unfortunately, at anything like the 25% level, to my knowledge, that doesn't exist. But a well-diversified portfolio of high and rising dividend-paying companies can generate a solid, sustainable income stream that will grow over time and keep pace with inflation. If you'd like to see a video going into more detail on retirement income strategies or other ETFs you're considering, let me know in the comments. By the way, the idea for this video came from one of my favorite people in our Discord, which you can join from the link in the description below if you want to continue the investment conversation. If you've enjoyed this content, please hit those like and subscribe buttons, and we'll see you in the next video.